welcome, and thank you for joining. I'm Mike Kettner, Director of Investments with Coastline, for those of you who don't know. So we are really fortunate to be joined by Alicia Levine, PhD, today. Alicia is a very frequent guest on many, far more viewed and more important things than this on CNBC, CNN, Bloomberg Surveillance. We were laughing yesterday, the Star Destroyer behind her was a topic of conversation on Bloomberg Surveillance a few months back. It's quite an accomplishment. I think her family should be very proud. But Alicia is the Chief Strategist and Managing Director for Bank of New York Mellon Investment Management, an authoritative, if not the most authoritative voice for market analysis and compelling investment outlook. But Alicia is here to answer some of the questions that we've put together to try and figure out where we've been and where we're going. So to start, Larry and I are going to take a little turns here, but Larry has the floor.
Thank you. Alicia, the global economy and the marketplace has experienced some very extremely rare things since the beginning of 2020. And you know what happened to the GDP last year, what's happening now. What is your sense of how that impacts where we are now and where we're going to be going over the next 6 to 12 months?
Well, thanks for the question, Larry, and thanks to you and Mike for having me today. And there's no place else I'd rather be than speaking to your clients, because in the end, this is where the real world is, and this is where people really have to decide where their allocations are. So I find these very important, and I welcome all the questions. So thank you. So yes, I mean, look, this was the most unusual recession in the real economy, the most unusual recovery in the real economy, and yet in some ways it was a usual market. And so what do I mean by that? So it was the fastest, recession on record, something like 5 or 6 weeks, something like that. So we came out of it. And then also the market was the quickest bear market in history, 34 days. And then it took about 124 days to recover to the old high, which again was extraordinarily fast. But the interesting thing is, if you go over time and you look at the 1-year return from the bottom of March 23, 2020 to the following year, we were up about, let's call it 72, 75%. It turns out that after the recessions and bear markets of 2009 and 1982, it turns out you had similar returns, something like 65% over that 1-year time period, the bounce off the bottom. So the performance of the market is slightly more extreme because we're up about 90% from that low, but it's not entirely ahistorical. And why does that matter? It matters because if you think about market performance after 1982 and 2009, we had some very strong returns over the next decade once we bounced off the bottom from those bear markets. And so it's something to think about as you look forward to the present today. If history rhymes at all, what we've seen is you can have rapid market gains coming off the bottom because there's a lot of skepticism about where the real economy is going. We think about the debates and the headlines we had last year where the economy was going. So it makes it easier for the market to move higher. But then the second year of recovery and the second year after the bear market, the returns are harder to come by. So you're obviously not going to have an extraordinary year in the way you had last year, simply because it's, you've already had quite a lot of price performance, but also the composition of the market with your 5 large cap tech names comprising 25% of the S&P, we think your cyclicals will outperform this year. It'll just be harder on the index level to reach the heights that we saw last year.
Thank you.
Very good, very good. Following the news these days, what we've heard about, fiscal stimulus, rescue, infrastructure, and, combined with sort of a little bit more under the surface, FOMC-led monetary policy that's been incredibly accommodative and sort of unprecedented in that sense. What kind of effects are we seeing now, and what can we expect to see over time?
Wow. like we are just in the middle of raining money. We are raining money. We're raining money from fiscal and we're raining money from monetary. So I don't have to do the numbers for you guys. You know it. I mean, we passed $5 trillion of stimulus in 2020 and 2021, direct, and most of it was direct aid to households. So that's 25% of GDP. That is the largest in the developed world. So the US fiscal stimulus was the largest in the developed world, and much of it went directly to households. In terms of the spending of that money, we're spending more in 2021 as the economy reopens than we did in 2020 when we were shutting down and we faced the void of actually not knowing where this virus was going to take us until about November. So we're spending more in 2021. And through September of this year, the government is going to send $1.2 trillion to households. Okay, $1.2 trillion. That is an enormous bolus of money. So that's the fiscal side. On the monetary side, we're in a completely new regime. So in this 2 summers ago, the Fed talked about being in this new regime of average inflation targeting. And what that means is the Fed is not going to be anticipatory. It's not going to preempt good data and stronger economic growth with the fears that inflation might go higher. It is going to wait. So in many ways, investors are in a bit of a halcyon place here because we have stronger than historical economic growth in the real economy. It could be as strong as the 1950s in nominal GDP. And at the same time, you have a Fed that has told you it is not going to cut it off. So we're in a pocket. We're in a very strange pocket. And it may be unique in history. And so with so much liquidity, with money supply having increased M2 27% year over year, very hard to be short. And it's very hard to be permanently bearish because there's so much money in the system. Now, that doesn't mean you can't have a 10% correction or even more because maybe asset prices have gone too far too fast. But it does mean there's a floor under this. And in the end, recessions and recoveries are choked off by a Fed that moves in anticipation of something that may happen in the future, not this Fed, not this framework, and not this average inflation targeting. And so that's why we just think there's a floor under the market here.
So Alicia, do you consider the historically high valuations on stocks and on bonds, are they justified?
So I'm actually slightly more concerned about the bond market actually than I am about the equity market, because if you think about it, our 10-year is at 157 today, maybe 156, I think when I last saw, and we're looking at 10% nominal GDP growth this year. So what a disconnect. What a disconnect, right? So yields should be higher. Obviously, they're being kept low artificially by the Fed sitting on the short end and essentially using forward guidance to tell the market we're not raising rates and don't get too ahead of yourself. So in some ways, I think that the bond market is more overpriced than the equity market. What's happened in the equity market is fascinating because valuations are high. However, because earnings are coming in so strong, you've lowered forward multiples. So you're not hanging out there at 23 times next 12 months. You're hanging out there at 21.5 times. That is still high. Don't get me wrong. And there are pockets where you still have overvaluations and froth, which we can talk about later. But we are growing, and we are growing the fastest that we've been. And probably for the next couple of years, we'll have higher than better trend growth with some higher inflation. And that's ultimately good for equities. Not so great for bonds.
Well, that's an excellent segue to the next question, because that I word you used has become a first order or primary subject of conversation on our client reviews and in a lot of conversations. So we hear a lot from the monetary authorities that they expect it to be transitory. Transitory meaning temporary, right?
Transitory, right.
Mm-hmm. So that is the $64,000 question. Are we entering a transitory period of inflation, or do you feel like it's going to be something more than that?
So, in our modeling of the real economy, we actually see a higher risk of inflation. And so, yes, we're definitely in the midst of that, what the Fed is calling transitory. And I think we all can see it. We can see it everywhere. Prices have gone up for food, prices are going up for rent, prices are going up for cars. There's scarcity, and there's scarcity in the supply chain. So we see prices moving up on goods. We have manufacturers telling us that input prices are higher and that if they can pass it on to the consumer, they will. So you're seeing that kind of spiral in input costs moving to final goods and to the consumer. On the other end, but that's just in the goods sector. So the question is, what happens in the services sector? Because most of the economy is the services sector and not goods and manufacturing. We think you're going to actually see some inflation in the services sector as well, because we don't think adjustments are going to be all that quick. When everybody wants to leave the house and go out to eat at the same time, you can't all go to a restaurant because there aren't enough. And, just as you saw supply chains break apart last year in the manufacturing sector, actually the supply chain sort of broke in the goods sectors. We have 25% fewer restaurants in the United States. We still have hotels that are closed because it's not worth it for them to open. These things just don't happen overnight. And so we think there'll be some pricing pressure there as well. Finally, let's talk about the labor market. So interesting. So the latest jobs opening data, we call it the JOLTS data, Job Opening and Labor Turnover Series, right? It tells you literally how many jobs are available in the US. The last data showed 7.4 million jobs open and available in the US. Well, we have 8.5 million workers who are not employed, who were employed in February 2020. It's almost a one-to-one correspondence, and yet businesses all over are telling us they can't get labor. So you hear it in manufacturing, you hear it in construction, you hear it in travel and leisure, you hear it in restaurants. That suggests to me we may be in the beginning of a wage price spiral.
Interesting. So now, historically, we would use commodities as a hedge against inflation. Is that still appropriate now, or what else should we be looking at in this environment?
That's right. I think ultimately investors need to position their portfolios with higher inflation than we saw after the global financial crisis, right? So after the global financial crisis, average inflation was about 1.8%. And if you look at what the market is pricing in 10-year forward inflation expectations, it's pricing in 2.4%. Now that's not enough to bother the Fed at all. And it's telling us, anything a little bit over 2%, they'd be pretty happy with. But the real message is that the market's pricing in inflation that's 60 basis points higher this decade than the previous decade. Okay, so that has certain implications. Yes, we like commodities here. The thing about commodities is you not only buy yourself some protection from inflation, but you can also get return out of it. So you get return plus inflation protection. We think that's a great way of protecting portfolios from inflation. Also real assets, so real estate, REITs are fine as well. Tips are okay, but not great. Because it really does depend how yields react. And if the Fed is sitting on yields to some extent, you'll get some protection from tips, but I like using commodities and real assets as a way of hedging. So I think that's really important. And I think that, REITs are fine. They're fine to do this. And as well as, high yielding stocks, there are a bunch of staples out there whose prices are just sort of dead in the water in the equity market because they're not exciting, but they yield 5, 6, 7%. And I think that's a fine way of getting some yield.
Thank you, Alicia.
So one of the other big questions going forward is taxes and tax policy. What kinds of tax policy do you think are likely to be implemented? Anybody can talk, right?
Yeah.
And what do you think the effects on the economy and the markets are going to be?
So here's my line on taxes, right? So economics is not a hard science, it's a social science, right? So there are very few laws in economics, but if there's anything that's close to a law, is that if you tax something, you get less of it. And if you tax capital, you'll get less of it. And if you tax investment, you'll get less of it. And so the taxes that are on the table, so there's the individual rate, there's the estate tax, there's the tax on corporates, and then there's the tax on investing and long-term gains, the capital gains. I think the taxes that are most detrimental to the market are the capital gains tax, okay, and the tax on corporates. And the other two are extremely unpleasant, and we can talk about them, but they're not going to affect the market, I think, in the same way. So it's definitely the case that the top marginal rate is going higher. I mean, all the Democrats agree on that, and they can pass that through reconciliation. So it's going to go to the 39.6%. The big question is whether the SALT deduction comes back in. I mean, we're all sitting here in these blue states, high tax states. We miss our SALT deduction. So, you know, with Pelosi in the House and Schumer in the Senate, I think there's going to be some trade-off there in re-implementing SALT. But that's really within the Democrats, right? So if the Democrats can do it with 50 votes, you'll probably see that trade-off. That won't affect the market so much, okay? What's going to affect the market is taxing capital gains at the ordinary income rate, which I've never actually heard anything. I actually can't believe it. I can't believe it. And so either it's they simply didn't run the numbers, or they're opening with a political salvo and it will just come in. And I think they're going to settle on something like 28% on capital gains tax, but you have to add in that Affordable Care Act tax of 3.6%. So then you're really at, what was it, 31.6% versus the top rate of 43. So investment is still advantaged. But I mean, many models have shown if you tax capital gains at ordinary income, you wind up with less revenue to the government because people stop investing and they stop doing realizations. And actually investors sell before the effective date. So in fact, the time during which you have that very, very high capital gains tax, you collect less revenue than if you hadn't done anything at all. So I think that's going to move a lot of moderate Democrats. I think it will go lower, but it's not going to be where it is today. So investors should be aware of that. I think the effective date of that will be when they sign the bill. Okay, it's very hard to do retroactive capital gains increases because investors functioned under a different regime. And I don't think that'll be retroactive to January 1. I think the ordinary income taxes can be. Corporate, again, as a government, why would you want your corporate tax rate to be the highest in the developed world? I do not know the answer to this question. The debate really is not about the 25 or the 28%. I do think it comes at 25%. Some of the more moderate Democrats have said they would only support up to 25%. The real issue here for the S&P, and investors should be aware of this, is the international tax. So there's something called GILTI and something called SHIELD. And it's a way of making sure that corporates can't hide their overseas income. If you add that 28% plus the GILTI and SHIELD together, the US will have the highest corporate tax rate in the world. And in fact, it needs the OECD to agree on a higher international tax rate to make this stick. Because if not, corporates will go back to what they were doing before, which is putting headquarters in Ireland, which has a 12.5% corporate tax rate. So this is not good for the S&P, and I'll tell you why. 40% of revenue for the S&P comes from overseas. So if all of a sudden that is much higher taxed, you're really crimping earnings here. And I think it's fascinating because the sectors that are most hit are technology and healthcare, in particular biotech, and in technology, in particular semiconductors. So essentially we're penalizing the two sectors that, one, we have a shortage in, and it's considered national security, that's the semiconductor industry, and biotech, which is getting us out of the pandemic. So those are the two sectors that are most adversely affected by this tax proposal. And it will hit S&P earnings by 8% in 2022 if passed as proposed. It won't, but if that's 8%.
I think you hit on a little bit of a follow-up here, but I guess for the folks listening, this is something that we discuss a little bit internally, but could you expand a little bit on the chip shortage that we're dealing with right now and I guess some of the implications for that? Yeah,
look, I mean, the chip shortage is leading to supply chain problems all over the place. If any of you have wanted to purchase a new automobile, you've probably found you can't get what you want. And so the automakers are having a huge slowdown because they can't get the chips. So the government, our U.S. government, is interested in providing support to foundries to actually increase to make chips so we can get the economy going. I mean, there is a little bit of a rate slowdown and an upper bound in how fast you can grow if you can't get semiconductor chips. So that's a result of the disruptions from the supply chains, and that will be fixed over time. But again, it will add to shortages and it will add to increased pressure on prices. But the government has recognized this as a national security issue because, it turns out that China doesn't have a chip shortage. So go figure. But I think the US government's very clear that it doesn't want our companies to have to deal with that for very much longer. So it'll support the companies with 50 billion to get things moving again, but we'll tax them on the other end.
Mike, Alicia, I see there's a question from a Stephen Mincone. Do you see it? I can read it.
Okay.
Stephen is asking, how can America remain competitive in a global economy going forward? Will automation be a net positive or negative for the American economy?
It's a great question. I think we do see it everywhere. We see that digitization and automation is kind of taking some jobs away. I think we all see it, whether if you go into a McDonald's or you're in the airport and you buy some things and you go to check out, you're at a kiosk by yourself sticking the barcode in, and that's getting replicated everywhere. So ultimately, I think you're going to see a reshoring of supply chains everywhere in the world. I think this just-in-time manufacturing has exposed both the national security risks and the health risks to the country. And I think that there's going to be a sense of you need to bring things back home. That will be very good for the labor market. It'll be very good for manufacturing. It'll be really good for blue collar jobs. And I think that that's actually a positive thing. If you think about the hollowing out of the manufacturing sector for the last 20 years, I think it's going to reverse somewhat. I think investments in education are a must, in STEM and technology are a must. And then there has to be some commitment to retraining the workers who are left behind as the economy of 2030 all of a sudden shows up in 2021 and 2022. And I'd like to see more emphasis on retraining skills to be more in sync with tech, because that's even where manufacturing and industrials are going. So that's the most important thing going forward. How do we take care of our labor force? How do we educate our population? And where do we make our goods? And all of that will aid to keeping America competitive.
Now, and thank you for that. Now, you know how traditionally we've used 4% as the spend rate on assets in retirement. And I've been seeing, our team has been seeing that things are changing in there. We'd love to have your feedback on that. Do you think that rule of thumb of spending 4% of your assets in retirement is still appropriate?
It has to change based on where yields are. So, we haven't modeled that out, but we can. If 4% is when, yields were, 4%, 5%, 6%, that's a very different world than when, your safe asset is 1.5%. And even in the most excited scenario, 3%, right? I mean, if we got to 3% yields, like that would be almost unheard of, and nobody's thinking about it. Could, but then you're still, then you have to take out less from your capital because you're returning less. And we know that, thank God, people are living longer. Thank God. And so you really have to take out less. If those models were put together when yields were higher, and you're in a mostly safe portfolio, the math is you have to take out much less.
Either that, or maybe we need to have a higher allocation to equities.
Or equities, or alternatives, or commodities. I actually have something I wanted to read for your audience, and I put it I took a picture of it, so forgive me. I'm just going to find it because I actually found this interesting because even if you're, even if you think, look, we're going to a green economy, there are going to be so many new jobs, there's going to be so much great investment. 10 years from now, we're going to have a completely retrained workforce. And I hope that's true. It's going to be fine. We're just going to have a few years. Let me tell you about commodities. Okay. Electric cars require four times as much copper as vehicles with internal combustion engines. Mm-hmm. And onshore wind farms are 4 times as copper intensive per megawatt as traditional power plants. So what does that mean? Even if we move to this halcyon kind of green economy, which we are going to get investment from the administration to do that, copper will be in demand, and in fact more demand, and oil will be in more demand because you need a heck of a lot of old-fashioned fossil fuels to move to the brave new world. So for those who are forward-looking and thinking, look, we're going to a brave new economy and we're going to be powered by wind and electricity, you need your commodities. Mm-hmm. And I want to emphasize that, there's no magic. There's no magic in the world. And so I think you need to have commodities as a core allocation, not simply because of inflation, but because it's going to be much higher demand as you get electric vehicles on the road and as you get more wind farms, as the society becomes more accepting of moving to a more green economy.
That's superb. Thank you.
That's very good. Yeah. I'm going to take a quick moment, folks. We're launching a poll here. Okay. So this is pretty self-explanatory. We're looking for your expectations for the year end in the stock market. So in the meantime, my own personal conviction, and those of us here at Coastline over the recent time, has been as U.S. investors. Is it too small? As U.S. investors, we have favored and focused on U.S. investments, U.S. stocks and things like that. Is it time to reassess that?
Look, it's a great question, and we struggle with this with ourselves and with our clients. This is the market we know and love. These are the companies we know, love, and use every single day. And we understand what their business models are because they're central to our lives, really more than ever. I'd say this. We do think we're in a slightly different regime going forward, meaning we've reintroduced the business cycle, right? So maybe more peaks and valleys, letting inflation run a little hotter, right? We're trying to get out of low and slow, so low growth and low rates. And so why does that matter? It matters because it means we think that cyclicals will do very well in this kind of economy. And it matters if you look at Europe. Part of the reason that Europe underperformed so terribly in the last 14 years is that the European economy has not been able to produce the kind of mega technology companies that the US economy has produced. Europe just doesn't have that kind of tech innovation kind of incubation the way we have here. So their stock market is filled with financials and manufacturing and cyclicals and industrials, and none of those stocks outperformed in the previous decade or even since 2007. So Europe is interesting because if you believe in the recovery, Europe is filled with cyclicals, and we think it's time to nibble a little bit there because we think you could get a higher return going forward. I like it when the headlines are bad. I like it when everybody's worried about COVID and Europe will lose yet another summer of tourism. It's not true in the sense that Europe is 3 to 4 months behind the US in vaccinations, and they will recover. And if you look at their bond market, the German 10-year bond is actually moving higher than the US 10-year is, and the French 10-year just went positive a couple of weeks ago, which is telling you the recovery is underway there. The banks are outperforming. Europe looks interesting. I know it hasn't worked. I know it's difficult, but I think it's worth a nibble at this point.
Would you say emerging markets? Because we've had a conviction that emerging markets investments, specifically with an Asian consumer focus, represent an opportunity. How do you feel about that? What is your perspective on that?
I've always liked emerging market Asia, and really coming out of the pandemic, particularly because the governments let's put it this way, there is not as vibrant a civil society in the sense that they can control the pandemic a lot easier than the US or Europe or the UK did, or Israel for that matter. So to that extent, you know, we like that there was growth coming out of this area. I think Vietnam is really interesting because I really do think those supply chains are coming out of China, if at all possible, and we'll go to Vietnam. So that's really something to look at. Go look at the Vietnamese market and see how it's performing against the Chinese market. I like that. I think the growth of the middle class, you know, the one risk there is your political risk. And I think we've seen it with Alibaba and Ant Financial, kind of idiosyncratic things that happen that could, you know, cast some doubt on the Chinese market. That's the one thing I'd be concerned about. But in terms of fundamentals, growing middle class, growing purchasing power, you know, integrated supply chains with other parts of Asia, with the US, I think that's a really interesting place to be. And you really have to be levered to the country that's growing the fastest in the globe and will soon be the largest economy globally, and that's China. It's hard to ignore it.
It's a little scary for me personally, but that's another story.
It's scary for me too. And to be in emerging markets, you need a strong stomach. You know, you need a strong stomach. You know, it's high risk. It's definitely high risk.
Thank you, Alicia.
Just to update if you folks, anybody who hasn't voted on the poll wants to go ahead, looks like it's a foregone conclusion, but I'll answer that, give you that little cookie in a second. So we touched on a little bit with valuations, but you hear words like euphoria, bubble, you know, froth. You know, where are we psychologically in this market, right? Are you worried about people getting too optimistic, too pessimistic, and you know, what does that mean?
So I'm paid to worry, right? My job is to worry all the time. I wish everybody worried all the time, because if everybody worried all the time, we'd have great market returns. Look what happened in April of last year when everybody was panicked, right? The market went straight up. So I had never seen an 8% S&P day in my life. So that was the day that we thought we would like never recover. So the market is not the real economy, okay? And ultimately, the market goes up when information is not priced in. I do worry that in some ways there's nobody left to convince, meaning we're all expecting a strong recovery. We're expecting the Fed to stay pat. We're expecting earnings to be terrific. So what could be the upside surprise from here? And that's why I think this year could just be harder to get returns, right? And I think those companies that people gave up for dead, you know, that they're tired of them, that they're not interesting. My 16-year-old doesn't want to buy them. You know, those are the ones that I think could work here, those deep cyclicals and deep industrials. I think the real froth is in speculative tech, even though we love those names for like the imagination of what these companies can do. I think ultimately in this market, with the risk of inflation and rising rates, you cannot be invested in speculative tech. You're going to get slaughtered. And you already are. I mean, I won't name names, but we know a very high profile speculative tech fund is down 33% year to date, because you can't perform in a world of rising rates in that kind of long-tailed assets. Long duration assets will not do well. Electric vehicle market got frothy. The IPO market got frothy. Those are the areas, you know, the speculation, the long-tailed assets. That's where you saw the most euphoria, and that's where you've already seen them come down to earth. I think there's probably another leg to go on the way down.
Thank you, Alicia. We have a question from a client saying, I am certain this is on the minds of many, but where have the returns on low risk options gone, i.e. CDs, and when can we expect them back?
Look, it depends on the rates market, right? CDs ultimately, everything piggybacks on you know, the 3-month and the 10-year and the Fed funds rate, and so until the Fed moves, you know, it's going to be very hard to get returns on safe assets, and that's why you see people going out on the risk curve. You know, if you think of a corporation's capital stack, right? So you have equities on the bottom; they're the least safe. And you've got bank loans on the top. They're the most safe because you've got secured, they're secured. And then you've got bonds in between. And so, you know, the safer debt instruments and the safer asset classes is very hard to get a return because they're all keyed off of the 10-year. And equities, which are the higher risk, has been the only place to get return. So I think that the credit markets are telling us that there's no stress in the real economy, interestingly. Even those epicenter names, meaning the travel and leisure, you know, airlines and energy and, you know, all those epicenter stocks that sectors that suffered so much in the real economy last year, they raised more cash and they have more cash on their balance sheets than other sectors because they actually used cheap funding to build a bridge to the other side of the pandemic, and they were very successful. Spreads are tight in the high yield market. Spreads are tight in the investment grade market. The credit markets are telling us that there's no real bubble out there, you know, that companies are doing fine. So you can invest in investment grade, you can do munis. You know, munis are going to be tax advantaged after all these tax increases go through. Munis will be tax advantaged, and plus the latest stimulus bill just gave $350 billion to cities and states. So munis look terrific here.
And, you know, Alicia, it's my hallucination also that one thing that's going to keep rates down is the Fed really, we can't afford to have the rates go up because of all the debt that we're carrying on our balance sheet as a nation now. It goes up, and servicing that debt, it's challenging already, if not almost impossible. Those rates go up, we can't pay the debt. We
Correct.
Can't service it.
Correct. We can't service it, and so we're in a pickle. You know, we're in a pickle. We're you know, I don't want to say we're Italy or Greece, but you know, debt to GDP is the highest it's ever been, and you know, we are keeping rates artificially low in part because there's no choice. We can't service it. Now Janet Yellen has said she's not concerned about servicing the debt yet. That, you know, she feels fine about that. I mean, she's quite.
She won't be around to have to service it. Our kids will be servicing it.
Look, you know, there's no free lunch. There's no free lunch ultimately. And the truth is, if you just look at Bitcoin, and I know that's one of the questions, but I'll get to that in a second. Why did Bitcoin take off? Bitcoin took off not because people are gamblers. Let's be very clear. These are thoughtful investors who see the debt problem, the softening of the US dollar, and the risk that the US simply can't get out of this. Like, how do you get out of this? You need enormous growth to get out of this, enormous taxes to get out of this, which is actually what the plan is to implement. So you know, the policies will inflate asset prices, and then the government will tax them away to help pay for the debt. So in a sense, this is MMT, right? This is MMT. They're not calling it that, but the government's figuring out a way to pay for it. And the reason Bitcoin was attractive, it is a hedge against too much liquidity and central banks blanketing the globe with cheap money debasing currencies. And so that's why I think Bitcoin is here to stay. I can't tell you what the market clearing price is, but these are not stupid people.
Thank you.
I think two things, because we will touch on crypto and digital assets as well, but I want to share the results of the poll and see what you think of it as well, Alicia, here. But by a pretty clear 2/3 over you know, any other answer, we have some real bulls here, some optimists. Now, granted, I didn't say how much higher, right? So we were talking, it could be, if somebody's out there thinking it's gonna be 1 or 2%, well, congratulations, right? But anyhow, what would you, I mean, does that surprise you, or is that what you expect?
I think, look, I've been in markets over 20 years, and you know, look, I love this country and I love the dynamism of this country. I think it's extraordinary what these large cap companies were able to do to transform their businesses in months and cut costs and really right-size the businesses. I actually never thought that was possible. I'm incredibly bullish on the spirit and the dynamism of the economy, and it doesn't pay to be bearish for too long on the US corporate sector. It just doesn't. And I don't like when stocks go down. I hate the way it feels, and I question everything, right? Like, I'm wrong. How could I think that? It's obvious. With this much liquidity, this much fiscal spend, and this much of the Fed taking a step back and letting it run, it's hard to be too negative in the short term. Okay, you can still have those corrections, and we should have a correction. It would take some of the heat out of it, but I think we're higher at the end of the year.
We just don't know how much higher, right?
We don't know. Look, let's put it this way. Earnings, okay, 2021 earnings started the year at something like, let's call it $175 per S&P share. That was like in January. We're moving close to 200 for S&P earnings for 2021. Put a 21 multiple on it, like, it's the market is supported because of earnings. And you know what we said to our clients, we put out our big piece in December talking about like our outlook for the year. And one of the things I said was, like last year, 2020, multiples drove S&P performance, right? Multiples drove the price action. So because yields were so low and real yields were negative, and we can talk about that in a second, your real yields are close to negative 1%. Wow, it makes sense to buy every long-tailed asset, okay? Because that's the only way you're gonna get paid. And you can't be in debt because you get a negative return after inflation. So you force everybody in the market, you increase multiples. In 2021, what we saw is that the baton was going to go from multiple expansion to earnings expansion. And that's what we've seen. The real economy kicked in. I think it goes for longer. And so therefore, I see the market higher.
How much longer would you say? I'd like to challenge you a little bit.
You should challenge me on this, because what the biggest risk in some ways, let's forget inflation for a second. We've addressed that, but we think the Fed's going to sit down for a while on that. The bond market could have a word on it before the Fed does, by the way. So I think there's another vigilante moment, whether it's either in the equity market, like look what's going on with tech the last 2 days, right? So there's some sort of vigilante action saying we don't want long-tailed assets. We know inflation's coming. And if the bond market's not going to do it and the Fed's not going to do it, we're going to do it. So there's some message today about tech selling off the way it has, and yields just sitting there at 1.157. What you should challenge me on is the fiscal cliff, right? I just said we spent $4 trillion in 18 months, right? Wow, insane. Okay, now what happens? What happens when the money disappears, right? So what happens? And so do you all of a sudden have a fiscally induced slowdown because you gave so much money in the short term that was either spent or saved? Much of it was saved. We think $3 trillion in excess in household savings, $3 trillion. Some of it will be saved. And then what happens after that? The risk you have is that sometime in 2022, you have a little bit of a fiscal cliff, right? You have taxes that kick in beginning of 2022, if not sooner, okay? And there's serious taxes, okay? The proposals are $3.5 trillion over, I think they said 15 years, okay? So what is that? 2.7 over 10 years. That is a lot of taxes. So those start kicking in. The infrastructure bill, in theory, starts funding in 2022, but in reality, it won't get spent until sometime later, maybe 2024, because as we know, infrastructure takes a while to get going. You have to plan, you need approvals, you need the municipalities. I mean, our former president talked about this, like, why does it take 2 years to get a permit for a bridge? So we know it's not going to get right into the economy. And so you do have a sense that there could be a fiscal cliff risk in 2022. So that's how you should challenge me.
I'm inclined to agree with you.
Okay.
So again, a lot of things there. Our last sort of prepared topic, and then maybe we'll see if we can, ad hoc a little bit, is cryptos and digital assets. As you sort of alluded to earlier, there are a lot of potential uses for these things. For myself and for us, and this is the part where I ask you to help me with my homework, for asset allocators like us, when is the right time to start considering these things? Like, to use the old analogy, it's sizzling, you know, but we're selling the sizzle, but is it time for the steak? Like, is that something I should be serving to my clients?
Yeah, look, I can't, this is a bad thing for me that I can't tell you what the market clearing price is for crypto. I can't, okay? I will say this, if there's only $21 trillion in Bitcoin and you have more investors interested in purchasing it, by definition, it goes higher. You know, we saw a 20% correction a couple of weeks ago within like 3 or 4 days. So that indeed is possible. I think in our minds as investors, we have to really decide whether we think it's a currency or is it an asset class. And in some ways, the U.S. government can't figure it out either, because the taxing on it is an interesting thing. Like, if you buy and sell Bitcoin, is the IRS going to tax you? Well, you know, if you bought and sold the euro, do you get taxed on that? It's a currency, right? You don't get taxed.
Right.
If you get taxed on this, then it's an asset class. So it's just, you know, you really need to, when you allocate to it, what are you allocating part of your cash portfolio? Or are you allocating part of your risk asset? And that is something that I think is unclear, and we need to think. I think right now it's acting like an asset class. To me, it acts like an asset class. It feels correlated with risk assets right now. And it's probably negatively correlated to the US dollar, meaning as the US dollar weakens, crypto goes higher. But that's something that, you know, as investors, and it's new, we need to think about. I'll tell you a funny story. I had an investor, 85-year-old investor, call me up and say, how do I buy Bitcoin? I don't want to be in any cash anymore. It's not safe. And this is a very conservative investor who's been in the market for 60 years. Okay. Actually, it's my dad. And when my dad said to me he wanted to buy Bitcoin because cash wasn't safe, you know, that was crazy. And I think that is something that we're all thinking about, because I think the weakening of the US dollar is a serious risk for inflation. Don't forget, you get inflation when the dollar weakens also. And when the dollar weakens, you also get commodity price inflation. So again, that's why you should have some core allocation to commodities. So I can't tell you when. Wait for a really lousy Bitcoin day. You know, wait for one of those days where something happens, and then I'd buy.
Yeah, I think if anything, like March taught us last year, if you don't feel physically ill buying, you're probably buying at a not such great time, right? Like, it's gotta feel terrible.
It has to be that it feels awful, and if it feels awful, it's the right time.
Mm-hmm. Mm-hmm.
That's excellent.
But really, it is an interesting question. Is it an asset class, or is it, you know, is it currency?
Right.
You know, at BNY Mellon, you know, on the asset servicing side, you may have seen the headlines.
Yeah.
We're creating a whole program for corporates to custody some of their assets in Bitcoin. Again, it's the question's not answered whether it's a cash asset or whether, you know, it's a you know, investable asset.
Yeah, I think, you know, it's an interesting wrinkle, because I just read this recently that one of the, you know, the proponents of Bitcoin will tell you, well, it's finite, right? That you can create it, but that it's a diminishing return asset. And so there's only so much, you know, at some point we'll hit peak Bitcoin, there's no more of it. However, it's such a new asset class. Somebody starts Bitcoin too, right? There's an inexhaustible source of alternatives to it, so that maybe it's not a finite asset. And
aren't there other
we know that
alternatives out there now, Mike? Are there other alternatives out there now? I remember reading something about different alternatives to it already, which I honestly don't understand. So therefore I fear it, because I have no concept of what I'm dealing with.
I mean, there's Dogecoin, which started as a joke, and you know, the kids like it because they can afford it. It's 75 cents or something like that. So,
well, it also makes their parents go, "What are you doing?"
Exactly.
So, you know, want to throw it out to the floor. We only have a few minutes left, but if anybody has anything they think we've missed, please put it in the chat. And then in the meantime, I think what I'd ask, again, sort of getting back to, you know, Alicia helping me with my homework. What particular areas that you see in client portfolios, what are being neglected now? I know we talked about international, but is there anything else that you think the average investor tends to leave out?
So the average investor is so levered to large cap tech and they don't even know it. So they may have something called large cap, or they may have something called large cap growth,
or an S&P 500 index fund, right?
and they may also have an S&P index. And so I think that is really something to look at. And look, these are phenomenal companies. I mean, the earnings season last week was extraordinary. And you have to own them. You can't let the world go by and not own these companies. They grow on their own. They're secular growers. They're eating every opportunity in front of them, and they're throwing off cash and throwing off earnings. And I love it when in those quarters where Amazon says, we're going to give you some earnings this time, instead of investing $5 billion. And you can see the earnings power. So you have to be invested in them. I'm just concerned about, we all own the same thing in many different names. And I think that's something that investors should look at. And I think everybody's underinvested in energy and cyclicals and value because they haven't worked in so long and nobody wants to be there. And I would look for those areas. And I do think that traditional fixed income needs to be tweaked, right? So you need to tweak maybe duration. So maybe you do 5 to 7 years instead of 10 years. Maybe you do something like that where you get some protection in a market sell-off, but you don't have the risk of the Fed raising rates in your face. And actually the 5 to 7 years is the cheapest right now. Add some tips to that. Maybe, add some, your rates are going higher, but again, add some high yielding stocks, REITs, commodities, things that can kind of give you some yield that are not so risky.
Mike, Alicia, I see that Phil G.
Yes, I was going to say, right. So our colleague Phil G. Marino has a question, very topical. There is an announcement that the president has announced support of patent waivers for vaccine producers in this case. What do you think the longer term implications of something like that may be?
So I guess my comment on this, wow, it took the German government to say they don't agree with this. If you're waiting for the Europeans to rescue corporates, we have a problem. Yeah. That's just a bad joke, but you all know what I mean. I mean, look, I started in this industry as a biotech analyst and biotech investor. So this is a sector that's near and dear to my heart. And actually, I was very bullish on the U.S. economy. Back in April and May, I knew the biotechs were going to get us out of this. I just had deep faith in it because they're very experienced with antivirals after the AIDS, after developing AIDS drugs. So you can't have drug development without IP. You cannot have it. And in the end, these companies only have 17 years of IP on composition of matter patents. And then they go generic and they lose the ability to get revenue on their investment anyway. I can't see how it's legal. I don't, in the end, that's why we have 3 branches of government. We have the administration, we have legal, and we have the legislative. There are going to be so many lawsuits about this because patent law is patent law. And I don't think the administration can come in and just overturn it overnight. It's really to get to India. You may know that India has a huge generic drug manufacturing capacity, and they want India to be able to manufacture it. I think we've seen even here in the US, these mRNA vaccines are very difficult to manufacture. We've had bad batches in New Jersey. So it's not really the patent that's preventing drugs getting to India. It's also the manufacturing. It's just hard. It's not so easy. Not great for these sectors, not great for precedent, not great for patent law. Again, if you need the Europeans to rescue you, it's not great.
All right, well, that really does kind of bring us to the end here, 2:59. I really, want to thank you, Alicia, for your time. Bob Kaler, who I neglected to introduce earlier in the call, is our relationship manager with Bank of New York Mellon, and partner of ours for many, many years. And again, thank you, Alicia. Thank you, Bob. Thank you, Larry, for your contributions here. And thank you to our clients for taking the time here in the middle of the day. We hope it's been beneficial. If you have any questions or follow-ups for us, please, you know how to reach us.